Welcome to Investing Insights, partnered by Right Property Group. This is your host, Phil Tarrant.
Good day everyone, it's Phil Tarrant here. Thanks for joining us for our monthly education series, Investing Insights with Right Property Group. For those of you who are new to this podcast, it's a monthly initiative that we do in conjunction with our friends at the Right Property Group, and I've got their two directors in the studio, Steve Waters and Victor Kumar. How you going, guys?
Yeah, well, mate. Yourself?
Good. It's been an interesting couple of weeks in the world of property investing and mortgages. If you haven't been aware or you haven't been keeping up with the news, APRA is sort of making some noise at the moment around mortgage lending, particularly high LVR stuff and interest-only stuff, and that's having an impact on investors. For those of you who sort of follow the growth of my property portfolio, you'll know that the Right Property Group work closely with me as my buyers agents to find me the best properties that suit my needs, my portfolio growth over the years. And this podcast very much a way in which we can step away from a lot of the stuff that we do on the Smart Property Investment Show, where we talk to investors and we can actually get down and dirty into the strategy of investing in property and the many and myriad tips, traps, tricks that you can find along the way. So what I wanted to do today, considering some of the noise coming out of APRA and overall noise, particularly as we come up to the federal budget soon, around trying to make housing more affordable, is have a chat with the guys and just really get their insights on the market as it is right now. But importantly, and something which I know is very highly connected to the way these guys invest and advise, is around responsible investing. And by responsible investing, I mean being responsible for your own investment strategy, being responsible for your own investment results, being responsible for your own financing. And I find that a lot of investors are quick to blame other people if things aren't working out for them. And my position on this is that you can have the best advisors in the world, but you need to be able to put your hands up and make your own decisions and be confident and comfortable in your own decision making. So I preface that with what APRA is saying right now. And Steve, you've had a good look at some of the communication coming out of APRA. In particular, they put out it's a bit of an open letter to ADI. So an ADI is an authorised deposit-taking institution, which means they have savings accounts, really, where they're trying to get the banks to curb lending to investors. And the purpose of that is to hopefully take a little bit of heat out of the market. And we talk about the market right now, and if you've been keeping connected with what's going on in property markets, the Australian economy, there's a lot of noise around the rampant growth of Australia's property markets. And I think a lot of people get confused thinking that property is firing all over the place in Australia and everyone's becoming a bazillionaire out of property in Australia right now. But when you look a lot closer, some markets are performing quite well. And you look at Sydney, keeps its sort of ongoing growth. But there's a lot of other markets in Australia right now which are hurting.
Well, there is, and I think there in itself is the problem. So people are tending to benchmark every single one of their potential results in every other state or suburb against Sydney and Melbourne, because realistically there is really only two markets that are outperforming the average, and that is Sydney and Melbourne. There are markets on the west coast, such as Perth, that is rapidly decreasing. Northern Territory, Adelaide's steady, Canberra's going all right, or the ACT's going all right. Not every market is Brisbane and Melbourne, and with these recent APRA changes, which in my opinion are long overdue, be it all, I'm not sure if every single one of the potential changes are the right way to go, but they will deem to think so. I think they're long overdue. We do need a change. We need some steadiness within the market, and that all starts with around the lending.
And we've been investing with you guys for quite some time, and I remember from very early days when I was a young investor looking to build a portfolio and building a portfolio quickly, you guys were always conscious of making sure I applied my own brakes along the way. So I was quite bullish initially and wanted to move quite fast, but you guys were pretty influential in shaping my view towards growing a responsible portfolio, where I wanted to go hard really quickly, and you're like, well, you need to slow down, find your feet, get your confidence, understand the markets, understand the game. And Victor, this is something, you must have hundreds if not thousands of clients over the years. Do you find that most investors come into the market, if they're new to it, really bullish and want to be rich overnight through property investment? And I wasn't that person, I always knew it, but there's a lot of people with a very different paradigm about what property investment is going to do for them And not everyone wins in property investment, do they?
No, they don't. And to go back to your comment, Phil, that you started as a young investor, man. You've aged gracefully.
I have, haven't I?
Yeah.
No stress portfolio.
no stress portfolio.
Yeah, that's right. So there's the portfolio is not
like
creating
a
any
fine
stress.
wine, aren't I?
Yeah.
Moldy.
Most people, when they start investing or they look at investing, they are usually inspired by a good result story, especially now with the advent of social media, and they try and emulate that quick result. But what they don't see is behind the scenes. What has happened now? There would have been education behind the scenes. There would have been some mistakes behind the scenes that people don't talk about openly. And as you know, Steve and I really openly talk about our mistakes. And they try and get onto a running start without addressing the fundamentals. And the fundamentals of property investing is really simple. If you can't afford it, don't buy it. And so you need to take into account changes in terms of interest rates, changes in terms of life events, employment, and all those sort of things, and forward predict that when you are investing in property, so that you're not ending up trying to play catch up in a market that's rapidly moving. So a lot of people are jumping into Sydney as an example right now, where the yields are rapidly diminishing, the prices are still on an upward trajectory, and it will become unaffordable as soon as you have one or two interest rate rises. So people come in with dollar signs in their eyes and thinking that it will all pan out. We'll find a way of holding onto the property, or they don't even address the negative side of investing and only address the positive side and think that everything will pan out. And that's when they get caught out. So we have, with every property cycle, we have measures put in place, whether it is by the government, whether it is by the lenders themselves, and sometimes they are to capitalize on the market itself, and sometimes they are to curb the market. So if you go back to the last cycle in New South Wales, we had those vendor tax being brought in, and that was a way of both capitalizing and curbing the market, and curb the market it did. And with APRA, they've started this so-called curbing the market since 2014. And it's been a long process. We're in 2017 now, and they're adding more and more measures in place to prevent, in my opinion, what happened in the last cycle, where we ended up starting to see 106% loans back then as an LVR on a single property. So it wasn't leaning against the equity of another property. And a lot of those people, when the interest rate started going up, they paid the ultimate price in either losing their homes or losing their credit rating because they couldn't keep up with the repayments. When you're investing, you need to be responsible about it. You need to understand that things won't be rosy all the time.
I think you've hit the nail on the head, Vic. This is just history repeating itself with a few different tweaks to it, really, and it's all starting from a lending. So last cycle we had the low doc loan. So
That's
it was
right,
how much money do you want? Sign here, press hard, and there it is. This is a little bit the same, being that money was pretty easy to get. Like over the last couple of years, we had the 95% loan, interest only, plenty of 90s around. And I think for the banks to come out and say, look, we're responsible lenders, and I'm not going to bash the banks, but for them to say, we're responsible lenders, we really want to be looking out for you. Well, for a lot of people, the horse has bolted. They should have been doing this some time ago. All that aside, though, this isn't a doom and gloom scenario. I think it's a necessary step from APRA or from the banks. It's a necessary step that will slow the markets down and perhaps, I suppose, get rid of the peripheral investor that, as you said earlier on, the speculative investor.
People that probably shouldn't be investing.
Shouldn't be investing. Yeah, their cash flow's too tight, whatever it may be. And they've got that whole FOMO scenario where they just think, well, property's a flavour of the month. Let's just jump in, throw a dart, hit a map, and we'll buy there, as long as it's Sydney.
So these are the investors that are playing catch up.
These are the ones
see
that
something on the net, and then
and I think it also really ties in with this whole adage that property investing is a passive investment vehicle, and it is the furthest thing from the truth. So if you're right up to speed with your portfolio and you're continually working on it, you'd be well aware that the lending changes are going to happen months ago. You'd have been speaking to the right people, and in that particular case, it'd be your broker, looking to adjust your rates, maybe even fixing some. So being involved in your own portfolio, as opposed to just sitting back and saying, well, look, time will take care of itself. I just know it's going to go up, and not look after the fundamental, which is cash flow, which is what it's all about with lending.
Yeah, and so if we explore that a bit more, Steve, a good portfolio is adjusted to the market conditions, and also forward predicting what's going to happen in the market, not necessarily in terms of where the economy is going to be or where the property prices are going to be, but what's going to happen in your life, and also things like the APRA changes. So it may be that you actually stop buying that particular type of property that's going to add more and more negative cash flow to your portfolio, and readjust the portfolio, bring forward a few constructions or subdivisions if those are the types of properties you've tucked away in the last cycle in your portfolio, to then make yourself more attractive to the bank, and also make yourself a bit more immune to what's going to happen in terms of lending changes.
Let's have just a real quick look before we move on about what these APRA recommendations are. And Steve, you touched on one. It's around sort of it's cash flow situation, but serviceability assessment. So I spoke with my broker the other day, and money might be 4% right now, you can get it, but in terms of your ability to service a debt, lenders are looking at your serviceability at sort of 7% on principal and interest as well, right? Which is really impacting the amount of money that investors can get. And I don't have too much of a problem with that. It just means that if you're going down this path, you've got a nice fat buffer if your life circumstances change. Responsible investing, that's sort of okay. What APRA is really trying to do is, and it's probably to take that peripheral part of the market out, just curbing interest-only lending from 40% of new lending to about 30% of new lending within banks or ADIs, loan books. So that's really just curbing the number of loans they're putting out on an interest-only basis. Now, you need to remember also, a lot of people frame interest-only lending as only relevant to investors. I think one of the key issues is that a lot of people have their principal place of residence
as interest-only.
As interest-only, which doesn't make a lot of sense. It depends if you're trying to ramp up a portfolio and drive hard, and obviously this is just general information. Some people might switch to interest-only, but I think most banks and APRA will be saying, well, why do you really need to have interest-only on your principal place of residence? So that's another thing as well. So they're trying to slow down interest-only lending. They're also trying to slow down LVRs above 80%. So anything between 80 and 100%, you obviously need to pay lender's mortgage insurance on, which ensures the lender in case you default. But APRA is pretty much going, is there a good justification why you're borrowing above 80%? So it means that you're putting 20% of the money in, the bank's putting 80% of the money. If you're putting 10% of the money in, the bank's putting 90% of the money in. Why is that the case? How is that going to influence your ability to service that debt? So these are just a handful of the recommendations APRA's putting in place. Obviously, a little while ago, they said that they wanted banks to limit their lending to investors, the growth in their loan book under 10%, and most banks are adhere to that. But let's be frank, when you look at the value of most of Australian banks, it's in their balance sheet. It's their mortgage book.
That's how they make their money, right?
Lenders want to lend money. Yeah. That's what they do. They've got to deliver to shareholders, and you'll find that most lenders will redline that 10% growth. It'll be 9.999%. You will see lenders often sort of just putting in different conditions and clauses. If they're going too close to that line, they'll sort of slow down a bit. One major bank stopped doing, I think it was top-ups on investor loans for a period of time. So there's a lot of mechanisms that banks can use to try and keep connected or adhere to these APRA requirements, because the banks don't want additional oversight, but they'll play the game according to APRA. But my position on this is that what APRA is saying makes a lot of sense to me personally.
Absolutely.
It makes a lot of sense. And if you're looking to borrow money and at 4% you're struggling to pay your mortgage, you probably shouldn't be investing. You probably shouldn't be investing. So these are the type of people that I think they're trying to take out of the market. And the idea is that without those people in the market, it's going to take a little bit of pressure on supply, because there's not going to be more people buying properties, and therefore it should hopefully slow down the market a little bit. But then again,
which is what we want.
Which is what we want.
Yeah, as in inverted commas, sophisticated investors, we want this market to be steady. We don't want the peaks and troughs. And we certainly don't want Sydney, even though it's nice owning property in Sydney, to have the results. It does play with the subconscious and really the averages at the end of the day. But
you guys see a lot of opportunity with less investors in the marketplace. You guys
all the time.
thrive in that environment.
Oh, we love it. Everyone go away. It'll be awesome. Yeah, it's just not a fact of life. But just on something about on APRA and 80% LVR, everything, like a lot of this is a little bit of smoke and mirrors from APRA and from the banks, because most investors will draw on equity from the principal place of residence, and let's say it is 20%, effectively it's 100% borrowings across the portfolio. So although reading these statements and looking at them and comprehending them, it is still a little bit of smoke and mirrors via the banks at the end of the day. And I think bigger deposits, and if it's genuine savings, that's a different story, and that's not a bad thing at all. I think the biggest key here is the cost of money. So it's the rate, the interest rate, because you're not going to lose your portfolio over lack of equity or declining equity. It'll always be about cash flow.
I was actually chatting with someone this morning about mortgage lending and the rampant growth in property price. We had a clearance rate in Sydney last week in 80+%, right?
Yeah.
With some properties going a couple of $100,000 over the reserve, right? And I said to this girl's mate of mine, and I said, for every $100,000 over that you might spend, right, at 4% interest only, that's $4,000 a year. So if you spend another $100,000 over and above what you expected, you only got to hold. It's only costing you $4,000 a year to hold that extra $100,000.
Yeah.
So this is one of the points, right? Money is cheap, and therefore people are going, it'll be right. It's only $4,000, but if that property's going up in value at whatever, it's not an issue at all. The issue is when money gets more expensive.
That's right.
Exactly, when it gets to 6% or whatever it may be. But the Reserve Bank's not. We're going to get into the whole economics debate, but the Reserve Bank's got a problem in terms of lifting rates. The economy's not that strong, jobs growth, what have you. So it's up to the banks, and that's one of their major levers, and then the levers will be passed on from the banks down to the investor. And once again, it's not a bad thing. We look forward to this. We've been saying it's going to happen for the last
years.
For the last couple of years, and for us, it's happy days. This is what we've been waiting for.
So my thoughts around, and we're coining this term, responsible investing. A lot of people frame responsible investing by what the rules are and what they can get away with.
Yeah.
Right. And my thought of this is that it should be the other way. You should be setting your own rules, and obviously there is parameters from which you can invest, and the banks will set policy so to influence how much you can borrow. But you shouldn't be investing. You shouldn't be borrowing as much as you possibly can because the bank's willing to give it to you. You should be investing within your means based on a strategy of what you want to achieve over time. And I think this is horse and cart or chicken and egg or whatever analogy you want to use.
Absolutely. And so one of those things is to be liquid over time, have your buffers in place because you're a stronger applicant to the banks. And that's at the end of the day, it's all about risk for them. So the less risky you are, the better the applicant you are, and potentially if you follow that all the way through, you'll get the money, whereas others won't.
So Victor, let's stick on this term responsible. Being a responsible investor. So if there was 3 or 4 things to be a responsible investor that you should be framing your goal setting, framing your portfolio growth, framing your strategy around, what would be those things?
First and foremost is don't try and play catch up. Don't try and compete with someone else who's got 2 more properties than you, or just bought a property and you both started together. You've got different set of circumstances. You've got different things happening in life. So that's the first and foremost thing that you need to look at. The second thing is that at the end of the day, just like Steve said, it comes back to cash flow. Yeah, if you're able to afford to hold onto the portfolio, that's what would be the key thing in terms of building the portfolio. So you would potentially buy properties where you can add that extra cash flow, or by doing a subdivision or a granny flat or a greater renovation to further capitalize on the increased rentals. If you've got your portfolio based that way and you across different states, so not having all your properties in the one state so that you're off different market cycles, you can play one state against the other in terms of how you finance and what you do with your properties. And at the end of the day, at some point in time, you gotta stop buying and start paying those loans down, whether it is through the various exit strategies, which we'll discuss in the later podcasts, or whether it is actually letting time do its magic. And over a period of time, you'll find that your loans are insignificant in terms of the value of the property. And equally importantly, if bought in the right areas where you've got good infrastructure and population growth, your rents continue climbing, which then helps with the cash flow.
So anecdotally, when you look at, say, your client base, would you say you've instilled that principle of responsibility into all of them, like you have done with me, where they know that you're a trusted advisor working for them, but it's incumbent on them to be responsible for their own position?
That's right.
Would you say that is a fundamental?
It is. Yeah, absolutely it is. And a lot of people, tend to abdicate that responsibility. And you see that often with the current affair factor of I took advice and it wasn't didn't pan out the way it was planned. That's life. If you haven't addressed the fundamentals, which is the affordability and building for a storm, but enjoying the sunshine, as they say, so that you are able to weather all these storms that come through. And this is a small storm in a heavily leveraged in a teacup. That's right. In a heavily leveraged portfolio, right? So it comes back to in the beginning, when you're talking about your portfolio, the LVR position overall is around the 70% mark, which gives you that option to change things around in terms of finance and so forth. And part of our process with our clients is we do a regular review with their portfolio so that we are planning for these glitches in terms of cash flow. We are also actively stopping our clients from buying if we feel that they're going way too fast. Now, some of them don't listen and they go on and buy further properties, but we try not to facilitate that, because at the end of the day, if you're buying too rapidly and you're not taking into account the negative cash flow that you're going to accumulate, whether it is negative cash flow in terms of differential between rent and mortgage repayments, or whether it is negative cash flow because of loss of tenants or repairs and so forth, they all need to be catered for and still have money left over so that we can then live to fight another day.
So you guys, you're not mortgage lenders per se, but you work very closely with your clients to ensure that their ability to service their loans puts them in a comfortable situation to help them grow and build their portfolio. So what APRA is saying is that serviceability requirements, and lenders are doing it right now, if they're looking at, if money's 4%, but they're looking at your ability to repay debt at, say, 7% on a principal and interest-only basis.
That's a good thing.
Would you say that's a good buffer?
Absolutely.
So irrespective of what, even if you don't use an ADI and they're not affected by these changes or these recommendations from APRA, would you say as a guiding principle you should be looking at your ability to hold your portfolio at that level?
Correct. Okay. Absolutely.
All the time.
Yeah.
But I don't think it's the problem that we as advisors or even as investors and speaking to other investors have, is that it's not so much the mortgage debt that is the problem. It's the auxiliary debt surrounding it, such as the car loans or leases and the credit cards and what have you, because let's not forget, they're at huge rates, huge. And just quietly, and as a side note, if the banks really wanted to be responsible,
cut down the credit cards.
Yeah. Well, it's credit cards still 21%.
Yeah, it's a joke. Compounding, like daily.
People holding $20,000 like debt on a credit card at 21%.
That's crazy.
It's just ridiculous.
That's a mortgage.
You can pay a mortgage off for that.
Yeah, I know, right? So, have a look at that, banks. But it's I think at the end of the day, people really need to take responsibility for their own scenario and situation. Advisors like ourselves can provide all the tools, but we can't go to the point of having AVOs out on us for saying, have you done this, have you done that, have you done this? But so there's got to be that self-responsibility.
All our listeners right now to this podcast, everyone should just do a quick reality check, I think, on where they are. So where would you start with that? Just would you look at that serviceability ability? So what would I need to be paying as of right now for my portfolio if rates went up to 7%?
Well, I guess the first question you got to ask if you're an investor is, do you know your numbers right now with your portfolio? Yep. So, take the tax benefits away. What is it really costing you to hold your portfolio right now? Yep.
In cash terms.
In cash terms.
Yeah, pre-tax.
Yep.
Pre-tax dollars. And just to answer that question in terms of if rates got to 7%, and coming back to what I said earlier and about being either a passive investor or not, there is no excuse for you to let your rates get to 7% in today's market. You can quickly fix loans at 5% for the next 5 years. So, being involved in your own portfolio, it would not get to that stage. In 5 years' time, you might come off and they might be 7%. That's the future that no one knows.
At least you've got 5 years to plan for it.
And 5 years, 3 years, 2-year fixed terms gives you multiple opportunities and massive amounts of time to rectify life for whatever's gone wrong in that cash flow scenario.
So if you have a good performing portfolio that you've bought well, so you've bought property that hopefully you've got an equity gain on the way in, or you've manufactured some equity. In terms of being a responsible investor, you should always be thinking the what if scenarios. If I had to get out of this today, if the sky fell in and I had to liquidate and fix my financial position, what would be my net result if I was to liquidate one property, two property, or my whole portfolio, and would that get me out of trouble? And I think about this all the time. What is the absolute worst case scenario? And if everything went to shit, would I be okay? Yes, no worries, that's okay. So that's part of being a responsible investor.
I think
it
is. Yeah, I'm exactly the same. I run 3 budgets, whether it be on my portfolio, my life, or the business, whatever it may be. The top end budget, which is not airy fairy, but let's talk about a portfolio here. But it's where it is. That's the top line budget. I run a middle budget. Whereas if I have a bit of vacancy, then I have this absolute flatbed budget. Worst case scenario, can't get a tenant, rates go up to 10%. And what do I need to do to survive? So that gives me that sleep at night factor.
Yeah.
Because if I've got that covered in all scenarios, then
Can't go wrong.
Then bring it on, because it'll give me opportunities elsewhere.
So what would you need to do in that situation would be you would need to offload a couple of assets and probably fix your cash position so you could maintain or hold the rest of the portfolio.
Correct. It wouldn't get to that stage because I'm involved in my portfolio every day, and if I'm not, someone else in the office is, Vic, as we talked about before. It's about having the buffers in place, and cash is king. We've said it all the time. For the last couple of years, everyone's saying equity. We said no. Cash is king. Have it somewhere, whether it's an offset, redraw, whatever it may be. But you need to be liquid.
Have the money before you need it.
Always. Yeah.
And do you think investors are getting that slowly but surely?
No.
Or they're going to be forced to do it because of the banks will make it?
I think for a lot of investors, for some investors, I think it's too late for that. They've utilised every little bit of equity, cash, whatever it may be that they have. And if they keep their jobs, they might survive. But there'll be a portion of people that will unfortunately suffer, and they'll probably suffer hard. But I think, and I'm hoping the majority of investors, with the amount of education that is out there, and there's some really good education that's out there that you don't have to pay for, that perhaps they've got themselves in a really, really good position where they can now perpetuate their portfolio because others can't.
So if you feel overexposed right now, so if people are listening to this going, it sort of sounds a bit like me, if I just get one thing falls over, I'm going to be in trouble. Victor, if you are sort of feeling a little bit overexposed, what should you do?
First thing is to do a reality check. So look at all of your mortgages, talk to a broker, see whether that can be fine-tuned, and protected against any imminent rate rises, because they will go up. Yeah,
it's going to happen.
That's
for
right.
Sure.
Yeah. And the other thing that you need to relook at all of your rents, whether you've put them up. So try and fix it that way. And if you really want to take a drastic measure, after speaking with the accountant, see whether you need to offload a property or two, so that you can live to fight another day. There's no sense trying to hang on to something that you just pretty much, waiting for the inevitable, and then losing the lot at the worst time possible. You might as well just, rationalize your portfolio now, so that you can then capitalize and rebuild later down the track.
So it's okay to, if you don't have a massive advantage, to retreat now and live to fight another day.
Absolutely.
When you're fitter, stronger. Regroup, move forward.
And learned.
Yeah, absolutely.
And in terms of, your earlier comment, Steve, with, buying properties need to be bought with taking into mind your own financial fingerprint in the sense that, it needs to match what's happening in your life right now, your income, how much negative cash flow you can afford, whether you can afford a prolonged period of vacancy or repairs or anything like that. So they need to be taken into account. So someone buying, as an example, in Sydney, and you're trying to emulate that person, that might not be the right property for you, because you can't afford the negative cash flow that most Sydney properties bring to the table right now. So you're better off perhaps buying in another area, which maybe Queensland, could be any of the other states, where the property market is still going up and the yields are significantly better. And your deposits, especially considering that most lending will go down to 80%, there's less deposits required.
That's good. Okay, really enjoy the chat. I think it's what I would take out of it is it comes back to being responsible for your own portfolio. Don't outsource responsibility.
Be aware of your situation all the time.
Be proactive.
And if you need more information around these APRA recommendations, I highly suggest you speak to your broker. They should know, and if they don't know, find a new broker. It's a bit harsh, but it's fair enough, I think. Or go speak to your bank directly. But you go to the APRA website yourself, just Google it, look at the most recent sort of press releases and stuff, and you'll see this open letter in particular, which was dated 31st of March. It'll just give you a bit of an insight into some of the parameters that the banks are having to operate within, and it's just really working out how that's going to influence the way in which that you can either maintain your portfolio or continue to invest in. There's opportunities in every market, isn't there, Steve?
Always.
There's always opportunities.
Yep.
And the more in tune you are with your personal situation, the more in tune you are with the market, the more in tune you are with your ability to borrow, the better you can capitalise on those things. So,
and can I just add one final comment? Everyone be aware, though, as finance is tightening up and that perhaps your pre-approvals are running out, that you shouldn't get FOMO and just jump in and use it just for the sake of using
the asset still needs to stack up in terms of So don't forget the fundamentals of why you invest in property.
Exactly.
You obviously want to buy something that's going to go up in value as quickly as possible, and it's as cheap as possible to hold.
Absolutely.
That's pretty much the basic fundamentals, isn't it?
Yeah.
It's good. Thanks, guys. I really enjoyed it. For our listeners, if you've just found this podcast, look, thanks for tuning in. But there's a whole bunch of other episodes that we've recorded, in-depth episodes talking about a lot of the issues in investing in property and the opportunities. Most recent one was around negotiating property, which was really good. Really drawing on these guys' experience negotiating on hundreds and hundreds of properties every single month. We speak about also other episodes, why a balanced portfolio is an important factor, units versus houses, goal setting. We bust a lot of property myths, and we also look at a lot of things that successful property investors don't do. So go back, look at the other episodes, listen to them. If you've got any questions on this episode or any of the other podcasts that we recorded, email questions@rightpropertygroup.com.au. You can also check the guys out at the same place, rightpropertygroup.com.au. You're on all the social stuff, just search Right Property Group. Any questions, these guys will be happy to chat with you. Just drop them an email and try and set up a time to get them on the phone, but they'll be happy to help out if you just need information. It's the best way to go about it, and that's probably the most fundamental thing that all responsible investors have, and it's a passion for education. It's a passion for better knowledge of the marketplaces so they can make more informed decisions. So I hope everyone listening to this podcast is a responsible investor, and if you're not, start thinking about how you can be better at it, because the world is changing, and change has a lot of opportunities in it. If it's going to get tighter to borrow money, that's okay. It's going to take some people out of the marketplace, but for smart, savvy, educated investors, there's a lot of opportunities out there, so go and get them. So thanks for joining us, guys. Thanks you.
Thank you.
Really enjoyed it. And we'll see you back again next month on Investing Insights with Right Property Group. Thank you. Bye.